European central banks are rushing out assurances of support for financial markets if the latest Wall Street upheaval severely disrupts trading. The U.S. Federal Reserve has taken emergency steps to calm the markets as investment bank Lehman Brothers announced plans to file for Chapter 11 bankruptcy today. Bankruptcy would mean the end of a 158-year-old company that survived world wars but could not outlast the global credit crunch. The Wall Street giant says the filing will not include its broker-dealer operations and other units, including Neuberger Berman, which it plans to sell. Ahead of the announcement, the Fed said it would begin accepting equities as collateral for emergency loans for the first time. A consortium of 10 global commercial and investment banks, including Barclays, also announced plans to provide $70 billion in credit. This is to offset a potential squeeze. Barclays said it walked away from a merger to save Lehman as it was not in the best interests of shareholders. In recent weeks, investors have become increasingly worried about Lehman's $46 billion worth of mortgages and asset-backed securities. Lehman lost an estimated $3.9 billion in its fiscal third quarter after fresh write-downs on mortgage assets.
Lehman, like so many other investment banks and banks, really got, quite frankly, caught up in the housing bubble. But like every bubble, the bubble ended, and we're now seeing the downside of that bubble.
If you just keep stepping in and keep rescuing, it doesn't restore confidence by the market participants that things are okay in the market.
U.S. regulators have also moved to protect customer assets held by Lehman, the fourth largest U.S. investment bank. An extraordinary Sunday trading session in the $455 trillion derivatives market opened in the U.S. so dealers could limit the damage from the fallen giant. Business analyst Ivan Ng of Fund Supermart tells us why the derivatives market held the rare emergency session.
Well, firstly, we have to understand the rationale for opening up the derivatives market on a Sunday. A very particular type of derivative known as the credit default swap is actually particularly at risk from this unexpected bankruptcy filing of Lehman. And the market now knows that this extremely rare event was done to allow existing positions to be squared off, so that well as to mitigate any potential contagion effect from affecting Asia further than it already has. So this credit default swap is going to be probably an issue that the market will have to contend with going forward, as a lot of insurers are also heavily invested into this particular type of derivative.